All right. Good morning, everybody. CPI day. We don't have the founder's notes yet from Spot Gamma. Um, but from what I saw in the options, the market's not really pricing in a big move. And it looks like volatility is going to drop off tomorrow, not today. So normally we'd get an economic data print, a highly anticipated economic data print, and then volatility would fall off. But with PPI tomorrow, it looks like that's where we're going to fall off. We do have the spot gamma levels, starting with the SPX and the ES on the right. And then we have SPY, the Qs, and then the NDX and the NQ. So you can go ahead and capture a screenshot. All right, so 7:30. Well, let's use East Coast time. 8:30, 9:30, 10, 10:30, 1:30. It's a full house today. There's something going on every single day or every single hour, it seems like. Not a day to really take your eyes off the news. Thinkorswim has a built-in news flash system similar to Finance Juice, but it doesn't have the same resources. Like if you use Finance Juice and you're on a logged in account, it doesn't have to be a paid account, just an actual, you're logged in. You can adjust the filter so that you don't see everything everywhere, because it's a news aggregate source. So it's going to aggregate news from places that maybe you don't want to hear from: CBS, Fox, CNN. You can go in and adjust that filter. On Thinkorswim, it has a thing called Trade Flash, which runs from a very expensive product called Hammerstone. You get the free version of Hammerstone for free using Trade Flash. We'll get to how to find it in a minute. It's a very expensive monthly service, so getting any kind of access to that thing for free is really useful through the day. But today's going to be one of those days where you really want to watch what's going on, because there's going to be very likely conflicting economic data. And they're really ramping up the debt ceiling talk. Almost every place that I tried to listen to this morning was going on about the failed talks from yesterday, how there was no progress made. And if they don't get something done in the next 8 to 10 days, they're really going to run out of room, run out of time to be able to formulate something, put it on paper, get it passed through the system to get done in time before what Yellen has stated is a line in the sand of when they're going to run out of money. So, it's kind of it's a deal. It's a thing. So here we're looking at Hong Kong. They closed down again today. They had an inside day breakout. So that little bit of a recovery yesterday when they happened to rally back up off of the lows, it didn't do them any good. It went back down, broke out today, and closed outside just barely, but barely counts. We still don't have a lower low. So we have that going for us. But until this turns and starts going up, we won't even count this pivot point yet. Right? So we don't know that this is a higher low yet. And we won't know until we start printing candles in this direction. Then we'll be able to point to it and say, oh yeah, that's a higher low. Until then, all we have is a lower high, and then now a higher high. That's our first higher high and our first higher low. Remember, we talked about Japan having closed before really the bad news had come out yesterday. You could see how it affected them today with that tremendous gap down. And they didn't even attempt to close the gap. They just continued moving to the downside. They did close inside day, and I haven't yet made the measurement, but it really looks like they closed below the 50% mark of the previous day's candle. And we still have a gap down here that needs to be filled from this bullish awakening. But one step at a time, inside day breakout. They basically had, a pretty uneventful day where they just gapped down, held the range, and went into the close without a lot of fuss. Europe is basically flat at this point. They're not done for the day. They can still change things around, but at this point, they are doji, sticking into the lower part of the day. And they are in IX10 at this point, 2 days in a row inside of a previous day's candle. But it's not very exciting, this IX10, because the day that they're inside of is a really wide day. So, if it was something really narrow like this and we had an inside day, then it becomes more of something we would want to pay attention to. As you can see, when we left this really tight zone, we really expanded nicely. But when we are inside day behind a really big candle, there's not really much compression or any expectation of follow through. Here we got the dollar. Nothing changed from yesterday, since we're still sitting basically where we were yesterday, inside this really big candle, and now inside of the 9th price action. Right, so we're inside day, we're IX10. We got nothing here. The levels that I gave the other day was below 101 or above 103. You could even tighten that up to 102.5. But we're nowhere near either one of those. And we're just really range bound. And the phrase comes to mind, don't diddle in the middle. Leave it alone. You can guess or anticipate which way this is going to go, or you could just wait for it to start to actually do that. It's not about doing it right or wrong. It's just more about what suits you. When it comes to the anticipated move today on CPI, a couple of months back, and it might have been in the later part of last year, everybody was saying, oh, don't worry about it. The CPI is supposed to be a dud. We're not expecting anything. And oh boy, it was a heck of a move. So they had really undercut the anticipated impact, and the markets were caught off sides, and we had this really big move. It's always an overreaction. So after that big move, everybody started pricing in big moves for CPI. And of course, once you start pricing a big move, then you don't get one. And so they were overstating the move. And that happened for, I don't know, 3 or 4 CPI prints. And now they're nearly normalized. They're not underpricing it and they're not overpricing it. It's almost the Goldilocks spot. I've seen a lot of articles in the last few days that has been pointing that out, right? So it's not like, you know, my collected wisdom on it. And that's something you really want to think about. You don't have to know how to do everything out there. There's a ton of free resources that will do things like evaluate the anticipated move of the markets due to the current volatility for the CPI print, right? So don't feel like you have to run out and learn all this in a day or a week. Stand on the shoulders of giants. Follow the work of others who have done it for 40 years and, you know, they kind of got this down pat. It'll save you a lot of trouble. Which basically means read some articles, maybe watch a couple of YouTube videos dated for the day, right? Not something from 2 weeks ago or 2 months ago. It's one thing that I don't see enough newer traders doing. They're always messing with their own charts, trying to do it on their own, trying to figure it all out instead of paying attention to some of the resources that are around you. My own 2 cents. All right, so we can see that the volume is kind of on par with yesterday. We're below 100. That implies the market is sitting out waiting for CPI, which makes perfect sense. We've been waiting on it all week. No reason to give up on the wait now. We did have a move through the kill zone between 2 and 4. When I first came in the office, it looked like we were going to reciprocate that move, but we stalled out underneath yesterday's low. So we had an inside day breakout with a Busby that didn't materialize into a payout on the Busby, and it didn't materialize in a failed Busby where we got back inside price. We have a market maker move today of 0.5% stacked on top of an ADR of 1.25%. So we put those two together and we got 1.75% expected move on the day. Now, if you're kind of new to that terminology or even the concept of an expected move, nobody's saying it's going to move 1.75% or that it has to move. And even the phrase expected move kind of implies that we think it's going to move that far. And unfortunately, that's not the way it works. If we think about how far a market could go, you would want to use an analogy of how far a car could go with the amount of gas that's in it. So if your fuel gauge on your car says that you could go 100 miles, nobody's saying you're going to go 100 miles, just that you could with the amount of gas that you have. The expected move of 1.2% or 1.25 isn't telling us that we're going to go that far, just that we have the capacity or the range right now to make that kind of move. When we stack it in with a market maker move, we can then say the market has the capacity to move 1.75% today, and it wouldn't be an outlier. It wouldn't be shocking to see us go to 42.15 today, or to go to 39.90 today. Those would not be out of line at all. I've mentioned it before. There is a pre-market setup that we get, or that we have the capacity to get, when we have an 8:30 economic event. Usually to find it, I have to go back to where I know there's a really good one. When you've been doing this for a while, you really want to keep track of particular days or particular situations. Mark them down, take pictures of them so that you can find them again, right? Because the old phrase is still true. The markets, they don't always do exactly what they did last time, but they're very similar. I compare it to a mahjong game a lot. And maybe I'm just kind of being cute with it, but I'm not far off the mark there. And while it might sound like I'm being silly, It's way closer to a mahjong game than I care to admit. If you can recognize the kind of day that we have today and match it to a day that we've had before, you're going to have a much better sense or feel for what the market's going to do today. Right now, the date that I'm looking for is November 13th, 14th, and 15th, and December 13th, 14th, and 15th. If you're using Thinkorswim and you're wondering how I can find these easily, the date is right here. So as I move my mouse around the candles, all I got to do is watch that area and I can see where the 13th, the 14th, and the 15th is at. This is the day that I'm looking for right here. So we had an economic event. They kind of started to front run it. 8:30 hit. We spiked. We had one very clean print to the upside. Right now, I'm on a 15-minute chart because on Thinkorswim, if you want to go back 180 days and you try it on a 5-minute, it won't let you do it. You have to go to a higher time frame than a 5-minute. So how far back I can go on a 5 stops really close to 90 days, I think. Either way, I'm limited on how far back I can go on a 5-minute chart. So I had to go to a 15. So this candle looks really clean on a 15. On a 5 and on a 1, it wasn't so clean. Doesn't matter. Either way, we expanded on the economic event print. We set a high, and then we spent the rest of the morning coming back down. We closed that gap, or nearly closed it. We didn't close it there. Tried again, and when we did finally close it, dumped really hard with a measured move, and it stopped perfectly on that measured move and then came right back up again. Now you might think, oh yeah, man, dude, you cherry picked it. You went right to the specific day. I did, because I wanted to show you what it looked like. But I can show you example after example after example where it does exactly this. So is it going to do this today? I honestly don't know. It doesn't always do it, right? If the market did something always, then we'd all pile in on it. Most of the time, if you get a big print like this, it creates a liquidity vacuum. It's a gap. And I know you don't see a gap, you see a candle. But there's a liquidity gap here. The markets don't like gaps, they don't like vacuums. So with this liquidity gap, once it was created, the market really wanted that gap filled. Think of it as unfinished business, traders who didn't get their trade. However you want to say it, however you want to approach it, just really keep track of where the move started, because that's where we're going to go back to. Even here with this big drop, the same thing happened again. It worked its way right back up to where the big drop happened. Then it fell back off again. Now, if it's a big move in two directions, right, and we get those kind of days where it's a big move in up and a big move down, then it kind of just negates the whole thing. Just throw it away. We want one really big print, and it doesn't have to be up. As we can see with the red one here, it can be down too. And we know it's going to be a pre-market thing. So once we get this print at CPI and we get into the open, we want to see price work its way back towards that gap close. That's the whole premise. Now, I know some traders will try to trade the big candle. Really look at your account size when you think of this. This market is closed, so we're looking at a candle that isn't moving anymore, right? Thanks, Captain Obvious. But when that candle was alive, that sucker was jumping around all over the place, and you would have had to have used either a really wide stop or some sort of order flow so that you could see the push in one direction. And that way you could jump in and like surf the price move without having to use a wide stop. Otherwise, you were just very likely to get stopped out. Trying to trade the big candle is a fool's game. It's like fake gold. It's doable. But what would you rather trade? the fade back down where you can size up with conviction and, put 10 or 12 contracts on, or use a giant wide stop and one or two contracts because you've got a giant wide stop, and then just hang on to this wild Bronco as it's wicking around all over the place with no discernible direction or analysis being able to be applied to it. Me, I mean, I'd rather trade with conviction. So trying to trade these big prints aren't the goal, right? So we have that capacity today. That's what's on deck, that we're going to get a chance to have one of these really big candles. And it doesn't always just happen for CPI, right? We got CPI, PPI, non-farm payrolls is another one where we'll get them. There's a lot of reasons to anticipate a big move right before the open, especially around an 8:30 window of time, right? Bonds and the dollar open between 8 and 8:30. And if there's been a lot of anxiety going on and treasuries being bid up and moved around, we can often see a lot of volatility and violence come in at 8:30 just because of treasuries. So really something to consider in that window of time. Eight 8:30, 10, 10:30, 1 o'clock, 2 o'clock. We've got a lot of things on the table today. And it's not just us. You can see that there is CPI and PPI on the docket for somewhere else in the world, because nations around the world are doing this, right? So let's go ahead and lay out this market maker move, just so that you have that, right? I like using these morning briefings as a teaching tool. It's literally why I do it. So I'll teach you how to do this. We already have the ADR. I've got it marked out from half of the ADR and the full ADR. So we know that this is 1.2, 1.9, it just moved. We can add the market maker move using one of two things, the percent value or the dollar value. A lot of newer traders aren't comfortable with the percentages and would just rather use the dollar value. So look at where the line is, 41.82, and just add $19 to that. That would be 42.02 minus $1. That'd be 42.01. And then put the change on there, 42.01 and 60 cents. Okay, so if we come up here and look, 42.06 is last week's high. Hey, that's good enough. If we get that close to a pivot, magnet and gravity, we're going to just go to that pivot. So we don't need a topside marker. We already got one, previous week's high. Take everything and do it in the other direction. 40.83, subtract $20, that'd be 40.63. Put $1 back, 40.64. 65 cents and 35 cents. Just use some easy math. That takes us back to 40.83 again. If we look at where the line is, or excuse me, 40.63. The previous week's low is 40.62. Close enough. If we get that close to that pivot point, we're going to go there anyways. Notice this move here from last week is what set the low. So if you're looking at that line and thinking, oh, wow, price tagged that line perfectly. No, it didn't. Price created that line. The line wouldn't exist if price hadn't gone there. Chicken and the egg, right? Which came first, the line or the move in price? the move in price came first. So what is the range that we could move today? Last week's candle. Hey, that's easy enough to remember. Just come out to your weekly chart. Look at last week's high. That's the expected range for the upside move today. And look at last week's low. That's the expected move of a downside push today. Simple enough. That's a really wide move. So again, nobody's saying we're going to make this move today. Just that we have the capacity today to make that move. If we apply a little bit of TA to it, we can see that last week's high is the 111 on a Fibonacci measure. The Fibonacci 111 is what I call the warning center. Is if we get there and we don't get through it, it is a warning that we're going to come back and retest the 100, very likely fail through that and test the 786, which we did. While we're on the weekly, since we're already here, really notice these last 2 weeks that when we got down below 4,100, we were bid right back up again. That there is a lot of activity down here and it doesn't look like they're done yet. So it's very likely if we sell off and we go to the downside and we get into that below 4,100 area, we can get in there, but we're very likely also going to come right back out of there again pretty quick. At least that's what we've seen so far, right? That there's big buyers down there and that those big buyers are bidding it up again. $10-day, 30-minute volume profile. We broke the point of control and we hit something. Now, the interesting thing is that's a shallow area. There's nothing there to hit. So very likely what happened is an alternate market hit something. Say the dollar hit 102 and rejected. I don't think that's it, but just trying to find an example of what it could have been. US dollar Japan maybe hit something, or the dollar hit, or the 10-year yields hit something. Either way, this didn't hit something. Another market did and stopped this fall. We're not done with the shallow area either. It really isn't going to be done until we get to the cog line at 4111. There's another cog at 4106, and then there's the roundy at 4100. Either one of those, and there's a cog at 4131. So now in a rally to the upside, we're going to have to get back through that point of control. And we can see that it is an area where price has negotiated and struggled. So now what was support is resistance. It's the way that it works. I'm going to take that VPOC off from yesterday. We didn't really revisit it again, but I had left it on there because this was a negligible impact. The idea was if yesterday we had went back up there, I anticipated there would be a reaction. But the day is done. Now we're in a new day. We didn't go back up there, and there's really no reason to keep it because it was hit. So it is no longer a VPOC. This one down here, the 4031, we did hit it in the pre-market yesterday, no less. And first touch play would have worked, but second and third, fourth, fifth, other alternate attempts to hold the line didn't work. It all failed. So we'll go ahead and take it off the table. Before I do, notice also that print and where we opened in the Globex this morning. Maybe it was just a coincidence, right? So no VPOC from yesterday. We still have one at 40.76, and that is in range, right? That is part of the measurement that we did earlier here. 40.62. This is 40.77, so we could easily get there, right? And as you can see, there is an old CPI print. It might be hard to see in the stream. I keep these lines really light. There was a CPI candle that I measured, and 50% or half of that move is the line that I have highlighted right now, 40.5675. Those really light lines are kind of an ongoing analysis that I'm doing, trying to see if those really old prints still have any weight. So far, it's just inconclusive. Seems to be more noise than anything else, but I don't know. I'll let you know if I find anything. We're still above the 10-week, but we are closer to it. If you remember yesterday, we discussed where if we were going to continue moving to the downside, that there is a 10-week moving average down here. So if we get those pivot points off the table, and we put a 10-week on, 41.13 is where that 10-week moving average is at. The other cyan line that I added right there, that is the 10-day moving average. And you can see yesterday how much we interacted with the 10-day moving average. If you were trying to trade yesterday, you think that would have helped? Just saying. Something to consider, right? Okay, with this sell-off, since we did not come back up and close that gap, we very likely are going to do that on CPI, even if it's a negative CPI and we go down. So what I did there is measured the big move and then plotted that big move in both directions. Kind of gives us some levels to focus on. We already have our measured move, but it doesn't owe us that big move, right? Let's say it that way. It's projected that it could make a big move today, but nobody says that it owes us that big move. And one thing I haven't mentioned yet, once you have your calculated measured move, this that we have up here, that's not an outlier. That's like going to the fridge, getting something. It's boring. There's no excitement to it. It's no shock and awe. So moving a 1.75% today would just be a shoulder shrug, like whatever, we didn't do anything. So if you want to consider what it would look like if we get surprised today, that number that you have up here, this 1.75, double it. So if it was 1.5 and we doubled it, that would be 3. Since it's 1.75 and we double it, that'd be 3.5. consider the S&P moving 3.5% today. So with that in mind, that would be like a 2 standard deviation move. We're still not even considering extreme yet. That would just be an outlier. So we could easily move 3.5% today. Now, again, I'm not saying we're going to, but we could. And it would just begin to be an outlier. Because of CPI this morning, there really isn't much cause or expectation that things are going to be moving around. We can see that nat gas is down and KWEB is down, but I wouldn't expect anything that is down now to still be down when we get to the open, or anything that's up now to still be up when we get to the open. Because when CPI comes in today, it's very likely going to be like an Etch-a-Sketch. It's going to just shake everything up, and whatever was there is gone. Poof. So don't really spend too much of your time and your effort and mental resources trying to really get a feel for all of the things this morning that we would normally look for. What's bid up, what's gapped, what might move today. You're really just spinning your wheels, and it's going to be a waste of your time and energy. Let CPI come out and really try to hunt down what the market considers this CPI print to have impacted, right? Did it come in hot? Is it really going to change the Fed's mind and kick this pause down the road? Or is it going to force the Fed's hand and make them hit us with another 25 basis point rate hike? They're already anticipating a pivot with an 80% at this point. And what we're looking for in this data print today is, will it now change this 20% number? Because we have an 80% chance that the Fed is going to pause for June. If they start pricing in another 25 basis points, the market's going to go down. If they don't start pricing it in and actually unwind it even more, the market's going to go up. So I think that has more value and more weight than trying to, perform technical analysis on a candle chart when we have a data point looming over our head. So use that, right? As much as I hate Twitter, it is a great resource. There are some very smart people. A lot of hedge funds and analysts are on Twitter. 30-year CMT certified market technicians and Wall Street analysts. And they share their stuff, and a lot of them share it for free. So their insight on how the CPI data reading today is going to affect us for the June meeting will be very useful, very valuable. I don't want to start going through Twitter naming names, but I have built a Twitter Discord because I really hate going to Twitter. And that Discord just gets Twitter posts from people that I deem relevant, and it posts their tweets in that Discord. The link to that should be in the description of the YouTube video for this morning briefing, along with the charts that I use. I might have pulled it out at some point, so maybe I have to put it back in again, but it's not a social Discord. There's nowhere for you to talk. There's nowhere for you to interact with other people. And of course, it's not a paid service. I just open the door, and anybody who wants to go in there can go in there. So it's not a service or a thing to pay for. All right, the financials are really lagging behind tech this morning. Both of them had that sell off in the overnight, but the NASDAQ has nearly reclaimed the whole move, while the ES is still stuck around the VWAP. Right, it just got above VWAP finally, but the NASDAQ blasted through VWAP earlier and has been hovering a lot closer to the start of that move. Dollar's still holding within the zone or the range that we had defined, and the 10-year is still sitting in that topping pattern. So this is really what we want to focus on for change. Seeing bonds break this bottoming pattern and yields break this topping pattern, and the dollar just to get the heck out of this box. All right, we're looking at the 30-year, the ZB, and you can see how we're on the lows of this structure, but we have the 10-week and the 10-day over our head. So if the ZB is going to make a move to the upside today to get an inside day breakout and begin this TRB setup, it's got a lot of work to do. But the thing is, this is setting up like a machine gun pivot reversal. They really need a new name for that. It comes from Rob, the guy that created the strat, and he talks about this particular setup. I call it a TRB, but what he focuses on is if you went short on this red day, your stops, or not you, but the institutions, whoever short this, their stops would be above that day. And if you got in to go short on this day, your stops would be above that day, right? Or this day, your stops would be above this. This day, your stops would be above that. On a setup like this, what he focuses on is if we started to get that breakout and we trigger into these stops, well, if you're short, your stop is a buy order because you buy to close. That buying adds to the fuel of the buying, and the market expands even more, which triggers into another level of stops, adds to the buying, and it goes even more, and to the next one, and into the next one. Now, it doesn't always work, right? Of course, because nothing always works, but it's why it explains a little bit why the TRB setup functions as good as it does. I hadn't really considered why the TRB follow through candle was so big until I got into that logic. There's one of those outsized moves right there. And if we follow it across to short traders, stops there triggered, stops there triggered, and then stops there triggered, and it just kept going and triggering more and more and more stops. So you can really get a big move on those. It is a lot like dominoes, isn't it? But if you want to hear more about it, the guy's name is Rob, and he's like an old school pit trader from way back in the day. And he developed something called the strat, STRAT. Now, I don't trade the strat. I don't trade his strategies. I can't even name his strategies all the way through, right? This is just one concept in a lot of different kind of styles and setups that he kind of, I don't know, goes through. Not my jam, right? So I'm not trying to take anything away from the guy or claim that any of this is mine. I'm just pointing out that's where I heard about that, and it's called, I think it's called the machine gun pivot reversal. if you want to search for it. He's an interesting person, that's for sure. So really, the idea here is we're looking for ZB to begin working its way back up. It could break this low, but we've been working on this low since March, or working on this range since March. Say it that way. So, breaking down here would kind of be a big deal. And just to kind of tighten everything up a little bit, look at all those wicks. There's a lot of defense down here. Now you can call it liquidity, supply and demand, and confuse yourself with all the fancy talk, but it's just liquidity. So if the ZB does go down today, it's very likely going to get defended and bid back up. If it doesn't, that would be a surprise. Markets don't like surprise and will very likely move fast. The 10-year stalled out on that push back up. It has not yet reached the trend line. But if it continues past that 10-week, which is where we ran up and we hit the 10-week and we stopped right there. I think I'll change this to something that maybe makes a little more sense. There you go. A line. So you can see we hit that line and we stopped. That's the 10-week. If we get above it, we're going to challenge this sloping line. This is red in percentages, right? So it's 3.97% for a 10-year. We're going to get concerned above, say, 3.6% or below 3.3%. And we're nowhere near either one of those. Don't diddle in the middle. No real reason to be concerned until we threaten the edges of this box. But getting to the edges of the box could very well happen today. That's why it's at least worth considering. 3.6 and 3.3. $10 minutes. US dollar Japan here. When it comes to what can impact the markets, very often this has a direct correlation to what inverse or otherwise to what's going on in the market. For inverse, gold. US dollar Japan going up, gold is going down. US dollar Japan going down, gold is going up. This is one of the reasons that gold was projected to have such a good year. Gold, precious metals, silver, until Buffett went over to Japan and started getting Japan bid up. And then that kind of squashed the whole gold's going to be strong this year argument. Now there actually is an argument. It's more two-sided. Either way, this 137, you can see how we took a rejection back in early March. And when we tried it again, it was soundly rejected again. But see how fast we can move. And right now in US dollar Japan, we are compressing with a lot of energy here. This is a candle pattern that is screaming that it has a full tank of gas. It is ready to go. So when the move comes, and not if, right? I didn't use the wrong word there. When the move comes, it is very likely going to be one of these big candles, right? Not little candles. And it's getting very close because it's running out of room in this wedge. So today or tomorrow, this sucker is going to make a big move. Now, I just said that it has a direct connection to the rest of the markets. What US dollar Japan does, you feel it in the ES, you feel it in gold. So if this is about to make a big move, so is gold, so is silver, so is the S&P. I'll leave you guys with that. Be careful, be safe, have a good morning. Keep your eye on the clock. I'll see you all tomorrow.